Why are some restaurant chains easily outperforming their biggest competitors? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, we are asking the question why chains like Dutch Bros, Chili's, and Texas Roadhouse are easily beating their top rivals. That is one of the more interesting aspects of the current environment. We are seeing a wide gap in performance between some very similar concepts. Chili's, which just reported a 31% same-store sales increase last quarter, is easily besting Applebee's. Dutch Bros is easily beating Starbucks, and Texas Roadhouse has been beating Outback Steakhouse for some time. So this week, we roped in old friend Joe Pawlak from our sister company, Technomic, to talk about the topic. Joe, welcome to the podcast.
Thanks, Jonathan. Thanks for having me.
Sure, always. So let me ask you this from the start before we get on to the actual topic of conversation. We're seeing a little bit of optimism about the restaurant business in some corners. Do you share some of that optimism?
Absolutely. I think, some of it is because we're dealing off of weaker comps from 2024. So, it's kind of one of those things, well, I don't think it can get any worse. I think that's part of the optimism. But also, I think the consumer, many price increases haven't been as aggressive over the past 4 or 5 months. We're starting to see moderation there. Consumers are feeling a little better from a confidence perspective. We're seeing some of the value meals again. Value meals in themselves aren't driving a lot of the traffic, but again, some of them are getting some traction. So I think we're feeling a little bit better for 2025 than we did certainly for 2024. So yes, I think there's some, I'll call it cautious optimism for 2025. Yes, absolutely.
So we're probably going to have a lot of geniuses in the C-suite this year, I think. Is that what you're saying?
Yeah, I think so.
Because of easy comparisons. I mean, yeah, that's the thing about same-store sales. If you have a bad year, you just wait a year and, you have a pretty decent chance of having a much better one if you do nothing.
But it's interesting that analysts are looking at 2 and 3 year stacks now, which is very interesting too. So, I think they're getting smart about it.
Yeah. I mean, because you kind of have to, right? It really is. I mean, same-store sales, like most data points have flaws, right? At the end of the day, you could probably find flaws in almost anything. But it's real. Same-store sales are easily manipulated, and they really don't tell you the full picture. Like for a perfect example, in January and February, I completely ignore same-store sales for the most part, because it's just too noisy, especially January, but early February in particular. You have bad weather one year, so so sales will be bad that year. But then, if the weather is much better a year from then, the next January and February, then not only are you going to offset some of the negative numbers from a year ago, but then you might be doing abnormally strong numbers anyway. So it was one of the first lessons I think I learned writing about restaurants was how big a factor weather is in performance and stuff like that. But yeah, just generally, I think last year for a number of concepts, I mean, Starbucks just reported their, end of year earnings, and, they did 4% decline in same-store sales, 8% decline in traffic by any stretch of the imagination, a really bad sales quarter for Starbucks, but they were, they did show some progress. I mean, that is good, but, ultimately the issue they're going to have this year is that they're going to have some, they much of the year, they're going to have very easy comparisons to deal with. And, so, Brian Nichols is going to look smart before he really has that much of an impact on the company.
Yeah, exactly. And let's discount, no discounting this year, no promotions, less of the bundling. That's going to raise check average, obviously. So I think, he's going to look pretty good this year.
Yeah. Yeah. And then, the other side of it is Chili's. Good luck beating a 31% comp.
I don't know where that came from. I really don't. And kudos to them. They've been showing, strong same-store sales, and all of a sudden 31%, which is just amazing. When you saw, Wingstop doing, mid-20s, we were saying, wow, that's phenomenal too. But for a mature brand like Chili's to be able to whip that out of nowhere was just phenomenal.
Right. Yeah, that's going to lead into this topic, but I do want to make a comment about Chili's
Yeah.
because your point is like the thing is like we've seen one of the things that we've seen actually in the last few years, the pandemic, 2020 and 2021 accepted because you got to throw those years out. They don't count, and they don't because too much noise. But it was comparable. Absolutely. Chili's quarter was absolutely comparable. The Wingstop, I think it was a second or third quarter of last year when they did a 29% comps on top of a 16 point and essentially a 46% on a 2-year basis, which was insane. Absolutely no question insane. And on a 2-year basis, one of the best numbers I've ever seen. Probably the best number I've ever seen. Popeyes in the fourth quarter of 2019, that was their chicken sandwich quarter. They did a 37% 2-year comp that quarter. Chili's was absolutely comparable to Popeyes chicken sandwich quarter, which, to your point, it's one thing for a fast casual or fast food brand to do this type of comp, these type of same store sales, because they have such marketing strength on balance. And they're kind of built for that, right? I mean, they got drive-throughs, they got mobile order and all that other happy stuff. And they can just churn people out. And if social media picks something up, I mean, that's what they can do. Chili's did it from a predominantly dine-in type concept. And in a sector that's been basically, been struggling and struggling and struggling and struggling and struggling for well over a decade and a half. And to do that is insane. And then if you look at it, I mean, their outperformance versus Applebee's this year, which is this topic of conversation. I mean, usually we usually see these, Applebee's and Chili's will usually be sort of comparable. To see some of this kind of outperformance is kind of remarkable to me.
Yeah, well, it's very interesting, and again, I think some of the others have kind of now are starting to jump on the bandwagon. This whole value proposition that they're promoting, that their burger is comparable in price to fast food burger. Oh, by the way, ours is better, and it's a better quality offering. It has resonated with the consumer. And that there's another option too, that you can mix and match a bit there. I think that has really resonated and is driving traffic. And if you ask me when they introduced this, how well is this going to do, I would say it's been there, done that. But I think the positioning that people realize that fast food prices have gotten very, very high, and that they're offering something that's very comparable in price, but knowing that fast casual burger is a very good product and always has been. I think anything's gone down with it. It's just that, the price point's been a little bit different, a little bit higher. So consumers are saying, well, that it hasn't had that value proposition that, why not Chili's? Let's go there. Let's go there for a better product. I think that's really won the consumer over.
Yeah. Yeah. I mean, they got some real strong marketing benefit last year. They, social media really latched on to this idea of Chili's being a good value, and they took off. But then they've been building on it. So, with Nashville Hot Maz, which went viral, so they're adding, decent products. By the way, they've cut from the menu, and that's an important point. So they, when one of the things that Kevin Hochman did, our restaurant leader of the year, by the way, super fortuitous naming him just before they reported that quarter. They were able to build on some early social media success and then just find a product that really worked. It just shows you that with the right type of marketing and thinking and backing it up with good operations, you can really perform well in any sector at any time. You just got to be able to, some of it is certainly luck for sure. No question about it, but you got to be able to take advantage of it.
And, as you said, social media, Chili's is hip again, right? I mean, it's got the social media buzz. Gen Zers and Gen Alphas go there now. So that they've kind of, I don't know what the formula is. Maybe they found it by accident, but they've kind of found the formula to get that Gen Z or that casual dining, the varied menu casual dining sector has really lacked, and has been trying to get for so long, and that's what caused a lot of their problems over the past, as you said, 10 to 15 years, where traffic has lagged.
Right. Yeah. It's no, it's I mean, my kids love it. I have a pair of Gen Zers. They absolutely adore Chili's. They've they never get upset when I say we're going to Chili's. They just love it. We've always had fun. And they're fun. Ultimately, that's sort of what those concepts should be like. You have to have fun and just sort of emphasize that. It's not about necessarily having the broadest menu on the planet. It's just about emphasizing, good value, a good enjoyable time, which is exactly why people go to the restaurant industry in the first place. And I think they've sort of hit it on all cylinders. Again, this year is going to be the absolute prove it year, because the last 3 quarters of the year, they are going to have some really, really, really tough comparisons. And that is going to put some pressure on them. But if they can maintain at least most of that for a while, you've probably got a formula for an absolute working formula. So
Absolutely, and they've reinvigorated the brand, which is not an easy thing to do in this business.
No, not at all. So let's chat about some of these comparisons. So some of these comparisons, because you at a presentation for the company not that long ago, you presented 3 scenarios: Dutch Bros and Starbucks, Texas Roadhouse and Outback, which is the first one I want to talk about, and KFC and Bojangles. All 3 of which are actually fascinating, and all 3 really point out basically the same thing. Texas Roadhouse has been easily outperforming Outback Steakhouse for a long time, and you kind of wonder if it's just Texas Roadhouse is Texas Roadhouse, and for whatever people, it just really has the absolute it factor at the moment, and it is what it is, and it's just tough for a brand like Outback to compete with. But each one of these essentially says the same thing, which is that consumers just like one better than the other, and based on all different metrics, pricing, atmosphere, value through quality, and food quality. Let's talk about Texas Roadhouse versus Outback for a minute.
It's interesting too, because you know, we did a number of comparisons, and we looked at brands within the same sector. So they're kind of within the family. So this is the casual dining steak sector. So we looked at Texas Roadhouse and Outback. We selected 2 of them. So if you look at things such as pricing versus competition, we know they're pretty close in pricing at the end of the day, right? I mean, the consumer, they go to one versus the other. We talk to consumers there. Yeah, they're pretty close. But when they start looking at factors such as atmosphere, value through quality, and then value of food quality, that's where Texas Roadhouse comes out ahead. So it's very much about a quality-driven product. So they think they're getting better quality and also doing it in an atmosphere. And then you go into Texas Roadhouse, it's just kind of a fun atmosphere. There's most times you go there, there's a little bit of a wait. So that, again, drives up a little bit of a demand sort of thing. It's kind of fun. Again, good atmosphere. Our view, especially in this environment, and again, given that we're seeing not a lot of the value meals giving a lot of traction, is that consumers are still willing to pay more. Okay, we're hearing about consumers pushing back on prices. Yes, we know that, but they're willing to pay more, but they expect more. And this is being really characterized and very reflected when we see Texas Roadhouse versus Outback. They just think they're getting more, and it's through value, quality, and atmosphere, and they're willing to pay for it in Texas Roadhouse. And, Outback is just not rated as high as Texas Roadhouse on those factors.
Yeah. To put just for the record, to put the performance into context, for the last quarter, the third quarter of last year, the last time both of them are reported. Texas Roadhouse did 8.5% comp. Outback did negative 1.3. The previous one, Texas Roadhouse 9.3, Outback negative 0.1. Outback Steakhouse has had 5 straight quarters of negative comps. Texas Roadhouse hasn't had a negative comp number since the fourth quarter of 2020. And really, and if you look at it, the numbers that they've been doing, and it's just so consistent, like 8 to 10%, quarter after quarter after quarter after quarter after quarter, and really showing that just consumers just really like Texas Roadhouse almost in a category by itself.
Right. Absolutely. They're just again. I've said this before. They're a machine.
Right.
Whenever you go to one on Friday night, expect to wait, and people don't seem to mind to wait.
Yeah. Well, I mean, it gets to your point, and this actually to the point of, especially with Dutch Bros and Starbucks, consumers are going to a restaurant, even if all they're doing is going through a drive-through, and they really want that experience to be really good. They're going to value that. I mean, I'm going to go back to the, so numbers that you had on Dutch Bros and Starbucks, because this is the one that stood out. And you got relative pricing versus competition. And, Dutch Bros scored a 112.4, which essentially means people really like it, 100 being a baseline, right? And then Starbucks 68.3, which is a 40-some point differential, which is insane because basically they have the same prices. Starbucks average check is $9.60, Dutch Bros is $9.10. That's a 50-cent difference. But probably some of that is food because a lot more Starbucks customers order food than Dutch Bros. Dutch Bros doesn't sell hardly any food. They sell 4 items at a time. So you're not getting food most of the time when you go to Dutch Bros. Most of the time you go in the afternoon, you're sucking on an energy drink. That is insane. To me, that differential. And it basically means that the Starbucks consumer right now does not think when they go to Starbucks that they're getting a value for whatever reason. And they absolutely do when they go to Dutch.
Yeah. And it's all related to service, because if you look at their service rating, visit speed, staff knowledge and friendliness, and some of that can be also related to service speed, that they're just rushed. They don't have that interaction that they have with the consumer as they had. And then also value through service, which is another factor. Dutch Bros definitely leads Starbucks by a sizable margin. So, that's where they're, and I think that Nichols is seeing that as well, that we're really falling down on service. He's talking about service speed and trying to make the process a lot more streamlined. And that's where they're falling down. And that's why we at Technomic think that, we look at our projections, Dutch Bros will grow 25% in 2024 from a system-wide sales perspective, and Starbucks is going to be flat. That's where the big difference is the service is really, and qualitatively, you talk to consumers, it's just been kind of a mess at Starbucks over the past 18 months or so.
Yeah. I mean, to illustrate your point, that value through service score, Starbucks got an 89. Dutch Bros got a 134.4. People really like the service at Dutch Bros. That's actually pretty fascinating because it's a drive-through coffee concept. Well, it's not even a coffee concept.
It's getting through quickly. Yeah. It's getting through quickly and getting your product correct. Yeah.
Right. And that's the thing, is that the innovative aspect of Dutch Bros is not really that it's drive-through coffee. And we've had coffee, kiosks forever. It's the fact that they paired it with really exceptional service and are proving out this point that, that a concept that is meant to just get you in and get you out. You're not going to linger in any form or fashion. I mean, In-N-Out does this to a certain extent, but they have seating inside, so you can actually go inside. But you're going in and out of the Dutch Bros locations, and they still win by service in a coffee concept. And because that was their highest score that you put was value through service. People really like that.
Absolutely. Yep.
Yeah.
And again, there's value to service. If you have exceptional service, there's a premium to that, and consumers will pay for it.
Right. So that's at the end of the day, it's really not all about pricing. It's what you're delivering for that price. So if you are going to, offer anything, it doesn't matter whether it's coffee, it's burgers, it's chicken sandwich, chickens and fingers. If you are delivering an outsized performance, and I think to me, I want you to address this part. To me, I think the restaurant industry is more competitive today than it's ever been. I think we're I think we're roughly back to where we were in 2019. We probably have more restaurants than there's demand for, in my opinion. And the consumer is just not willing in a scenario like this to tolerate something that they consider to be less than standard for whatever reason. And we're seeing it in over and over and over again. Chili's, Applebee's, Dutch Bros, Starbucks, Outback, Texas Roadhouse, KFC, Bojangles, and where they are, Domino's, Papa John's, by the way, they are absolutely picking winners right now.
That's right. Prices have gotten to a point where you can't afford substandard value, and that's where we're at right now. If I'm going to pay the prices that restaurants are charging, I'm going to want to expect better, best. And again, it's from a quality perspective, and there's elements beyond price that fall into that equation.
Yeah. If you look at the chains that have had the biggest problems, these companies, a lot of these companies get these financial issues. They have financial issues, and then they start focusing on they just start focusing on survival or whatever. Because they have too much debt, their leases are expensive, and for some reason they weren't able to get that combination. Those are the concepts that have lost last year for the most part, or brands that just did not have the right combination of whatever, and started losing on they started making brands start making compromises. You start cutting costs and cutting corners. You start relying too heavily on new product introductions without realizing what impact it does on your operations and stuff like that. And those are the ones that really struggled last year. If you look at those that filed for bankruptcy, or if, whether they're a franchisee or a brand, those are the brands that really lost. Red Lobster.
Absolutely. They took their eye off the ball, and what really means the most to consumer. They're looking at the bottom line and not understanding that, top line drives bottom line, correct? And, you have to invest, and, it's investing on the attributes that have value to the consumer. It's about service. It's about staff knowledge. It's about training your people correctly. It's about the atmosphere. It's about how your units look. There is investment. That's a cost, obviously. And, if you're cash strapped, or you can't invest because of because your financial situation, well, then you're already one step behind.
Right. Exactly. Any last minute thoughts, Joe? What is going in with the rest of the year? What do you think operators should be focusing on this year?
Well, I think this year is definitely a year of investment. And I think, that's a good segue, is that we have to invest beyond just talking about, we've talked about how the consumer is cash strapped, or just at a certain point, frequency has been reduced because of prices in restaurants. But we have to invest to make sure that we're offering that value, that they're willing to pay the price. So again, value meals, yes, to a certain extent, they have effectiveness, but it's not going to turn business around. We know that that's a race to the bottom. But what we do know is that what really promotes long-term growth in this industry is promoting value in other attributes. So if you want to charge a higher price, you've got to do the other things in your business. Train your employees, have, wonderful atmosphere so they can sit down, have a great, provide a great experience. Think about what you're doing in terms of how you're not only presenting your product on premise, but if you're doing delivery, how are you presenting your product off premise? That's something that needs to be talked about as well. Just because you present beautifully on premise, well, we're just going to put in some foam packaging and send it out. Well, consumer doing things more and want the same experience off premise as they want on premise. So we need to start thinking about that as well. So this whole value beyond price is something that is something we need to look at.
Indeed. Joe, this was great. Really appreciate you joining me this week on the podcast.
Thanks, Jonathan. Anytime.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. Or you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.